Hey, good evening, everyone, or good afternoon, I should say. Um, we're just going to give it one more minute. A lot of traders are still coming into the room. So I'm going to give it another 60 seconds, and then we're going to start. Hey, good afternoon. This is Mark from Right Line Trading, and thank you for giving me your time this afternoon. What we're going to be doing is we're going to be going over um, first our software. Um, there's a lot of new people in the attending this webinar, and then we're going to move over to the charts. I'm going to show you the micro contracts themselves, how they trade, how they behave, and then I'm going to show you a tool that's going to allow you to trade all four at the same time. I mean, look for signals on all four, and potentially get great trading opportunities on all of them. Now, first, a disclaimer that all signals and trading opportunities provided both orally written or electronically that are disclosed to visitors or subscribers are for educational and demonstration purposes only. Right Line Trading takes no responsibility for any participation by visitors or subscribers within futures or forex markets, nor for any profits or losses that may be incurred. Participation in trading in the futures, forex, and stock markets does involve substantial risk, and she understood that a person can lose a substantial amount of money. Therefore, the participation in these markets is not appropriate for everyone. Careful consideration of your financial position should be made prior to trading, and never risk more than 2% of your account in any given trade. Do your own due diligence. Right Line Trading is not a registered financial advisor, not a licensed commodity trading advisor. With that said, what we're going to do is we're going to be looking at the micro E-mini S&P 500, the micro E-mini Nasdaq 100, the micro E-mini Dow, and the micro E-mini Russell. If you're unfamiliar with these instruments, it's easy to determine how much a tick is worth. It's simply worth 1/10 of the value of the full contract. The E-mini is normally $12.50 a contract. So this is worth $1.25. The E-mini Nasdaq is 50 cents a tick. Dow is 50 cents a tick. And the Russell is 50 cents a tick. Now, forgetting what goes into comprising the amount of money, and I took this from AMP, and this is going to approximate how much it's going to cost for you with any broker. Total per side is going to cost you about 37 cents. So it's very, very inexpensive to trade. And margin requirements are also extremely low. Again, this is just an estimate from AMP, but in general, it's going to be a ballpark figure that you're going to experience with any broker. The E-mini S&P margin is $40, the Nasdaq $50, Dow $50, Russell's only $25. And in general, all you need is $400 in a trading account in order to start trading live. So the barriers to beginning to trade live have been markedly reduced. And when you're learning, this is not really a very bad way to trade. even if you lose a few dollars, trading live money can really be advantageous to a lot of traders. Very, very inexpensive to begin. Now, what I want to do is go over how our software works. I'm going to try to do this as quickly as possible. I'm going to go through all the questions, but because really my goal is to spend as much time on the charts as possible. But there's a lot of traders, there's so many traders who are new in the room that I just don't want to move over to a live chart without at least explaining a little bit of what you're looking at. If you have any additional questions, in fact, I'm going to encourage you at the end of the webinar to give us a call, and you'll see why at the end of the webinar. Now, for those of you who have been here before, this is gonna be a little bit redundant, but redundancy is never a bad thing. You always still learn something. And I think that one of the most misunderstood indicators that are out there, and an indicator in which there's very little accurate information, is that of the oscillator. I mean, if you put the oscillator into YouTube, normally if you put an indicator analysis or an indicator into YouTube, you'll come up with 100 videos that really give you good information on how to trade it, what it means, and how to interpret it. But if you do that with an oscillator, you're going to come up with really, really poor information. I mean, nobody really gives you much specifics or really provides you with really good, credible information as to how to trade it and really what exactly you're looking at. And George Lane created the indicator. He was a very, very brilliant mathematician. Now, he created this back in 1957, and it was really one of the first indicators ever made. I mean, he actually created this, I believe, before MACD was created. And what he was looking for was a way of assessing momentum. Now, momentum is a very, very interesting metric. It doesn't measure speed, it measures the rate of change of speed. So essentially, you're looking at acceleration or deceleration. Now, speed is a first order metric, but the rate of change of speed or momentum is a second order metric. So what we're looking at with an oscillator is the acceleration of price up to its target or the acceleration of price down to its target. And he correctly hypothesized that momentum, being a second order derivation, would be on its own a leading indicator, that momentum would change before price changed. And he used the stochastic oscillator that he invented only for one reason, and that was to foreshadow reversals on a divergent signal. He did not use it to track the direction of the trend. He used it solely to counter trend trade the market on a divergent signal. Now, just really quickly, I think the formula is important, because if you understand the stochastic oscillator formula, you really have a great idea of how all the oscillators work. Because relative strength, Williams percent K, ADR, ADX, no matter what the oscillator is, they're all created with this core principle in mind. And it's a really simple formula, and I think it's one that you should understand. Now, in the formula, C is equal to the most recent closing price. And then the indicator creates two moving averages. One is the L14, and that's the average low of the 14 previous candles or trading sessions. And H14, which is the average high of the 14 periods, which can be sessions or candles. And the percent K is at the actual momentum line. So what happens is, as the close of the candle continues to approach the low of the candle, this 14-period low, momentum continues to move to the downside. As long as that close with each candle gets closer and closer to the average low of the previous 14 candles. And as the close gets closer and closer to the 14-period average high on a long move, momentum is going to continue to rise to the upside. Now, here's the way to visualize this when you're looking at your trading chart. Price starts down here and it accelerates up to here to create this much momentum. It doesn't just rise, it's driving up and increasing in speed right up to this point. Now when it comes back and retraces and accelerates back up to the same high, it doesn't accelerate quite so much. So you'll get this much momentum. So on the same price high, price only accelerated fast enough to create a momentum value that's lower. That's a divergence signal. When price provides you with an equal high, but the acceleration of price the second time up to that high is lower, that foreshadows a collapse in price. And in fact, in this market, price tried to make it back up to this high or accelerate up to this price. It's not just about price movement or price rising, because that's just speed. Here we're talking about the rate of change of speed or the acceleration of price to this point. And it created the same amount of momentum. And then afterwards, because momentum was on the wane, it foreshadowed this collapse in price. That's what he used, that's what he traded. And I believe back in 1957 and 58 and in the 60s, you know, years and years before we were born, blah, 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 this was really accurate. And here's just another way that you can look at momentum or divergence. Here, price accelerates up to here, creating this much momentum. It comes back and accelerates up to a higher price, but it only accelerates with equal momentum. Now, if price makes a higher high, you want it to accelerate up to that high faster. If the acceleration to this high and the acceleration to that high are the same, that is also the harbinger of a price collapse. So price making an equal high on lower momentum or a higher high on equal momentum are both divergent signals, and both are going to foreshadow a collapse in price. Again, something that I think was seen very often in 1957 and the 60s and probably the 70s, when charting was very primitive, never any electronic, really sophisticated charting platforms. And there were certain things in operation back then that have changed dramatically today. Now, the other thing, and this is something that we really don't use, but I believe that was also accurate, was that stochastic in calling tops and bottoms also was really good when it became overbought and then crossed the 80 line to the downside and gave you a short signal. Here it crosses the 20 line to the upside for a long signal. 20 line to the upside for a long. 20 line to the upside for a long. Now here's a failed signal, but here's a cross of the 80 line to the downside, and boy, you get a big move down. And here's a cross of the 20 line to the upside, and boy, you get a great move up. And this cross down across the 80 line, we don't know how price did. You can see this is a very old slide, and I pulled it off the internet because I wanted to show how accurate trading these overbought, oversold signals were, back in the day. But now the market is different. And this is really the underlying principle by which we do all of our trading. And let me tell you, our trading is unbelievably good. I mean, I'm going to show you our results for this month, and we are just killing the market. And I am not kidding you. I'm going to show you my NinjaTrader back end. And the core principle that we use and that you have to take into account if you really want to become a successful, profitable trader is that a market can stay overbought for weeks or months, and that multiple divergence signals now no longer work. Now, some do work, but if a signal works sometimes and doesn't work other times, it becomes useless. Now, if there was a way to look at divergence and say, okay, this is a nicely configured divergence signal and has a better chance of being successful, this is one I'll take. Oh, that's a poorly configured divergence signal. I don't like that one. I can step aside. Then you could assess risk on the entry, and it would become a good signal. But divergence is divergence, and in general, some fail and some are successful. You can't tell whether it's going to work or not work, and that makes the signal useless. Again, it's because a market can remain overbought or it can remain oversold for an indefinite period of time. And there has to be a complete paradigm shift in the way you trade. Not only that, but there has to be a complete mental shift in the way you look at all indicators and all price analysis. Because here's what's operational today that was not operational, 10 years ago. Can't give you an exact time for it. But, and this has rendered Fibonacci, Gann theory, Elliott wave, even Japanese candlestick patterns fairly unreliable. And this is something you are not going to hear everyone anyplace else, because there's so many people selling you Japanese candlestick-based patterns. So many people selling you Fibonacci levels because they're so sexy, and people just gravitate towards them, even though they've never been mathematically validated to work. But I can tell you, in a market, the way the market trades today, they absolutely don't. It's because they're all predicated on this. Every financial instrument is a closed system. And you can look at it like any closed system in thermodynamics. And I always used to wonder, why does a market chop ever? I mean, who makes money in chop? I mean, essentially, everybody loses because everyone's just handing their money back and forth. The market has no direction. It moves aimlessly. And if you buy, you're going to give your money to someone else. If you sell, you're going to trade it off to someone else. There's no trend. So why would anybody trade during a period of time when the market's choppy? And why does the market chop? And it's because it behaves just like any other closed system in thermodynamics. And that is that every closed system, by its very nature, wants to move to a state of maximum randomness. In thermodynamics, you want to apply energy. And if you apply energy to that closed system, you can create order from disorder. In the market, which is also a closed system, if you apply money, you can create order from disorder. Now, so it's the institutional money that creates the trend in the market. That's what creates the order in a closed system that by its nature wants to move in a totally random, aimless pattern. Now, this wasn't true 20 or 25 years ago when there was no institutional money around and there was nothing but just this huge number of commercial traders. All of these systems like Elliott Wave and Fibonacci probably were much more successful because here's the major principle that no longer is operational. And that is that the power of each individual buyer back then was essentially equal to the power of each individual seller. When that's true, then divergent signals work. When that's true, Japanese candlestick patterns work. Because when 400 years ago, when the Japanese rice traders created these patterns, they were basing it on market sentiment that was created by buyers and sellers that were equal in power. So the doji, the dark cloud cover, the piercing candle, the engulfing candle, they had a lot of throw weight. Try trading them now in the era of institutional money. The only way that you can make it, and the reason why we're blowing it away, is because our only goal is to determine the direction of institutional money and trade with it. And institutional money doesn't care whether there's a previous engulfing candle or a doji. It doesn't care if there's an upcoming fib level. It doesn't care about Elliott Wave or Gann theory. It's just going to run it. It's going to create or skew this closed system. And I don't want to, overdrive this point, but it's so critical to the way that you have to trade. I mean, if you look at the law of thermodynamics and the way that electrons revolve around a nucleus, you can define the different orbitals, the s orbit, the p orbit, the d orbit, the f orbit, sp, d, f. All those electrons move in a defined orbit in a cloud around the proton and the neutron. And that's your closed system. And all the forces that are brought to bear on that closed system stay constant. But all of a sudden, if you apply this massive force, like institutional money, the closed system goes crazy. That's why the only thing that you can do is track institutional money in order to be profitable. Now, a lot of software tells you that they can track it, but it's not easy because the institutions don't tell you when they snap on a computer. I can show you a great move today on crude oil that we had a great entry signal. I mean, it was stellar, but volume was lousy. And over the course of 3 candles, they formed in 15 minutes, was 12 minutes. Then institutional money stepped in and it created a massive move to the upside in literally 3 or 4 seconds. And crude was up, I don't know, 35 or 40 ticks. So the market did nothing. I didn't take the entry because I don't take entries on really poor volume. But in the middle of this move that almost stopped out, institutional money exploded it to the upside. So how do we trade in an era where institutional volume rules? And here's part of the way your trading methodology has to be. You're going to be successful. Now, I'm not looking at the micros yet, but I want you to see why our software calls direction so well. And the first thing is that there's no such thing as overbought or oversold. It's a fallacy now. There's no mathematical way of calculating overbought or oversold. A market like the Nasdaq today will continue to go up when everything, I mean, the Nasdaq was overbought in the early morning, and it just continued to drive higher and higher and higher and higher because institutional money was pushing it up. Stochastic were overbought, and they remained overbought for a couple hours. And if you try to trade against them, you're going to get stopped out. Markets are only going to reverse at the whim of institutional money only. And if you try to trade any other way, you're going to get stopped out. Now, the principle of reversion to the mean still applies, in that if you use a 50-period moving average or a 15 exponential or a 100-period moving average, that's your mean price. And price on your trading chart, no matter what instrument that you're looking at, is always going to want to pull back to that mean price. But it's not going to pull back to that mean price until institutional money steps aside. Now, the further that institutional money pushes price off the mean, 2 standard deviations, 3 standard deviations, the more snap you'll get back to the mean when institutional money steps aside. The problem is you and I and nobody on the face of the planet can determine when they're going to step aside. Sometimes they take a pause and a breather, and they come right back in and continue to push that market higher. It'll retrace a couple of candles, and then bam, it just continues going. What all these counter trend traders are doing are trying to get that reversion to the mean, that snapback. But to get that snapback, you got to be wrong about 6 out of 7 times. So there is no way. If somebody tells you they can call a top, they're lying. And I rarely make a statement with that much certainty. If somebody tells you they can call a bottom, they are lying, because you need a mathematical equation to do that, and none exists in the era of big money. So trading divergence is tantamount to trading against money flow. And the only thing you can do is trade in the direction of money flow. I mean, there's $17,000 software that calls tops and bottoms supposedly 3 weeks in advance. Good luck with that, because it's just not going to happen. That top is going to, wherever that top is going to be 3 weeks away, is going to be determined by big money. So what we're looking for are indicators that accurately assess buying and selling pressure, the kind of buying and selling pressure that can only be created in the presence of institutional money, not in the presence of us, the small commercial trader, but only in the presence of big money, so we can track it. One of the ways that we do is we use the Laguerre, and you're going to see the Laguerre displayed prominently. Now, I'm going to take a lot less time with all our other indicators. I'm going to run through them pretty quickly. And you're not going to get, as thorough grasp, but you're going to get sort of a roundabout grasp of what they're doing. So when you see the full charts, and I want to spend lots of time on all 4 of the micro charts, and I want you to understand again, that's the reason why I'm doing this. Now, the Laguerre is different than all the other oscillators. Its formula is much more complex, and it is used to track the direction of momentum. It really doesn't create divergent signals because it's not tailored to do so. It has a default gamma of 0.5, and it has multiple filters. We've altered the default gamma, changed the filters to create a percent K line that's really stellar for tracking momentum that you want to follow, the direction of momentum that can only be created by big institutional money. Now, what I wanted to show you here is how you're going to see it on the chart. Now, normally we only do another principle that I want you to know that's really important, whether you're evaluating my software or anybody's software, is that if it assesses only price on your trading chart, it has no forward-looking ability. If it doesn't do a multi-time frame assessment, and almost all our indicators look at 2 higher time frames, and we use them to determine where price is going to go, and they have tremendous forward-looking ability. And if you don't have indicators that do that, on the right edge of the chart, you're going to know where price has been, but you're not going to have any idea where price is going. And what I did with this box was to show you, now this upper line is the assessment of momentum on the long-term league year. It's a multi-time frame assessment, and this is a 3-minute, and this is looking at momentum or acceleration in price on the 9-minute and the 27-minute, and that's this line. And when this line locks green, back in 1957, you'd be looking for divergence. But in 2019, we're going to trade that lock long, because the only thing that can lock the year long is big money. So when the institutions decide to drive an instrument up or down, and they have only they have the power to lock that percent K line above 80 and plaster it up against 100 and keep it there. And that's what this line is showing you on the 2 higher time frames, the 9-minute and the 27-minute. Now, that we need to know momentum on our trading chart as well. It's one of the rare instances where a force that moves price needs to be assessed on your trading chart as well. So it's really pretty simple. When the long-term league year doesn't really have any general direction, you can see here it's red for a while, yellow for most of the time where there's no alignment, red a little while, yellow here, prices just chops. I mean, it's very difficult to trade. Then when the league year long-term goes green and the chart trading league year heads in the direction of the long-term, you get the arrow. When the chart league year crosses above the 20 line, now momentum is aligned to the upside on 3 time frames, your trading chart and your 2 higher time frames. Price is going to rise. And it's rising because institutional money is pushing price up. We don't want to trade a divergence signal. We don't care if there's a fib line there, and we don't care if there's a wave 3 Elliott wave. When the institutions are pushing price up, it's going to go up. And those computers and those types of trades will run over everything else. And here's another example. Here's the multi-time frame league year. Here's the chart league year. You can see it locks long a little bit. But if there's no direction on the long-term league year, the chart league year is useless. You can see it just kind of flops around. Doesn't give you any kind of entry. You have to have the chart league year moving in the direction of the long term. When the long term locks green, and you can see the arrow right here, it tells you that the chart league year has crossed the 20 line and its momentum is now rising. There's your long trade. And the only thing on this 3-minute that can do this is big institutional money. And that's how we trade momentum. And momentum is change in speed. So what we're seeing is that the market is accelerating in price to the upside. And the assessment of the Laguerre is pretty remarkable. On flat price action, you can see the long-term Laguerre assessment still rising. Momentum is still accelerating, even though price may not be rising. And I don't know how that works, but I'm telling you, it happens all the time. And you have to trade this market long. Now, here's another example. There's the cross. And you have to trade the market short. Now we have two entries. There's a number one, the arrow, the number two, the retracement and the continuation. But this is how you trade. And this is how you trade in the direction of institutional money. It's another trade in the direction of institutional money, a pullback on dual locked green Laguerres. When both Laguerres are locked green and you get a pullback, you're up and out. Here's a 30-minute up. Here's a 3-minute again down. So I think you get the idea that you have to throw away all your old principles and you have to simply trade in the direction of institutional money. That's your mandate. And if you do, you're going to make really good money. I mean, this month, again, I'm going to show you our trades. I don't think there's anything else because I don't want to get redundant. The only other thing I just want to show you really quickly is what I did was I compared the Laguerre to this upper one is stochastic and the lower one is relative strength. Now the RSI is a little more complex a formula, and the stochastic is your basic oscillator. Now here, the long-term Laguerre or long-term momentum is locked short. And the chart crosses right here, the 80 line down, across the 80 line, and institutional money is pressing to the short side. Now, the stochastic on this flat move here pops above the 20 line and takes you out. You have to exit a trade if you use stochastic when the percent K line crosses the signal line. So it pops you right out because it's not looking to stay in the direction of institutional money or track the direction of buying or selling pressure. It's just geared to look at something else. It's looking for divergence. And relative strength never even gives you a trade. So, and let me tell you, trading with this indicator, relative strength, or if you're trading chart alone, has absolutely zero predictive value. I've seen other systems where all you do is look at, there's 5 or 6 or 7 or 8 lines, and there's relative strength, or if you're trading chart alone, it's higher and higher, then you get all sorts of predictive associations about where price is going to move. It just is not going to give you any accurate data. It's going to move in the direction of institutional money. And this is not going to tell you a thing in terms of going into the future. And I'm just going to skip all these just for time. And I'm going to go to a different slide deck. So let me hang on 1 second. I mean, these are the actual charts that I'm going to get to very shortly. These are our micros right here. And let me just go to another deck and let me just find it. Where the heck is it? Hold on 1 sec. Now, hopefully I opened it. Hang on 1 sec here. I'm sorry. Here it is. Okay. Let me move this over. Let me start it. I'm going to move through a lot of this material because I really want to get to the chart. Now, the other thing I want to talk about is how we use order flow. Now, volume analytics have become very, very complex. And there are a lot of ways that you can assess, very elegant ways you can assess volume. I mean, this is a volume ladder where you can see the bid-ask disparity on each individual tick or cent or pip. This is just looking at market depth. It's looking at how many traders are sitting on the bid, how many traders are sitting on the ask. You can also use market profile where you get a point of control, value area high, value area low. And let me tell you, we've been there with all these indicators. And we have really a killer market profile. It stores volume data, it shows low volume nodes. It does the full 9 yards on market profile. And I'm telling you, it just doesn't work. And I could never understand the mathematics of it to begin with. And I don't know why I even ever made it, because it just doesn't make any sense to me. And I don't really want to go into the specifics of why, to me, it never made any mathematical sense. But you can see that slowly, you just don't hear much more about market profile and about those kind of volume analytics, because I just don't believe they work. Now, you can look at the bid-ask disparity inside each individual candle, again, pip tick or cent value, and try to use these disparities. This is a dual disparity in the favor of buyers, showing stacked buying pressure. This is showing stacked selling pressure. And there's software that pushes this stacked buying and stacked selling. But the problem is it's coming off your trading chart only. It only has the power of a single tick level, and it just doesn't have the throw weight and the predictive value to get you where you want to be, to give you the kind of precision you need to get winning trades time after time after time. I mean, it looks great and it's easy to sell. The problem is it doesn't work. And here's one of the reasons why. This 29.85 is the market delta value of this candle. And it really doesn't matter whether you're looking at stocks, futures, or Forex. It shows you that there's a bid-ask disparity in favor of the buyers. And this is an up candle. A problem is that you can get what appears to be buying pressure in a down candle. The market delta here is green, but the candle closed down. Now, how the heck did that happen if the market delta had that much predictive value in determining the direction of price? If you were tracking a moving average of market delta values that just were absolute values off your trading chart, it wouldn't give you any information. And that's the reason why, and here's stacked buying and here's stacked selling. Now, if the lower part of the candle has stacked selling, you would expect the next candle to trade down. But if the overall market delta value is green, what the heck are you supposed to do? Well, the answer is it doesn't work. And the reason this closed down, even though the delta was positive, is because the sellers here are more aggressive, even though there may be few of them sitting on the dome. I mean, if price is at 100 and the buyers are all waiting for 100.1, but the sellers are not waiting for 99.9, they're willing to take the market at 99.8 or even 99.7, and they're aggressively selling the market. and taking a lower price than they could potentially get, price is going to go down even though the delta is positive. So it skews the data. And if you look here at all these market delta values, you're going to see it's not common, but it happens. A negative delta on an up candle or a positive delta on a down candle. And that's just the way the data is. It's not a mistake. So if you look at this moving average of the absolute delta value on the right edge of the chart, it has no predictive value. It's not going to tell you where price is going to move in the next candle just because this is rising. And that's what you want to know, where price is going to go. So what we've determined is that one standard deviation's worth of data works. All the other data, or the outliers, in which infrequently aggressive sellers will take a positive delta candle to the downside, or aggressive buyers will take a negative delta value candle to the upside and throw them out and just use that one standard deviation's worth of data. More importantly, you can't look at any market delta values from your trading chart. And that's the whole problem with looking at this volume ladder from your trading chart and market profile. And again, I'm not going to go into any more detail about market profile, but I can show you mathematically where market profile just doesn't work. The point of control is good, but the value area high, and so are the value area high and value area low. They're just not traded correctly. And the way that they work, they just don't, they're not going to help you. So what we do with most of our data and most of our indicator analysis, we look at the two higher time frames. Now, if we're trading a Unarenko, which I love, I'm a range bar convert to Unarenko, although you can trade time or tick, doesn't matter. You're going to look at the two higher time frames. If you're trading a 3-minute, you're going to look at a 9 and a 27. If you're trading, say, a 377 tick, you can look at the 610 and whatever, the next higher fib number. Because fibs do have significant symmetry in nature, even though in today's market, they're not going to predict areas of support and resistance. And you put each of these delta values on the two higher time frames into a 15-period simple moving average. Now, because you're not looking at the absolute value of the deltas, and you're looking at 15 of them averaged together to smooth out the data, those outliers are thrown out. And the preponderance of delta values, which do close in the direction of the candle, drive the slope of the line and give you an accurate assessment of who is driving the market, the bulls or the bears. So when both 15-period SMAs are sloping up, the bulls are in control. And both SMAs on the two higher time frames have to be sloping down for the bears to be in control. And when the 15 periods are not in agreement, it's yellow. So this order flow line has tremendous precision. It saved us from taking just a walk-through loser today because order flow was in the wrong direction. I was easily able to step aside on this potential loser. And today I had no losers, 0 losers today, because order flow allowed me to step aside on what was otherwise a perfect trade. I mean, one important independent variable on that trade didn't align. It was order flow, and it saved me. And it's a leading indicator. When you get green, price is going to rise. And price rising doesn't turn this green. The fact that this is green is what's driving price up. Most charts, this is assessing price on your trading chart. So when it goes up, it turns green and tells you nothing. This is the two higher time frame market delta assessment, and the slope of those two higher time frame SMAs And when they're heading up, price is almost always going to rise. And when the order flow line is red, price is almost always going to fall. And it's going to turn oftentimes before price does, because George Lane was right. Momentum and order flow are leading indicators. Now, I just want to mention one thing that's very important in your trading methodology. It's very important to always catch traders in the counter trend direction and run them over when you take your entry. Like if our entry would have been right here. Now, I don't have any market structure here. I don't have the 15 or the 50. I don't know where I am, but this is a great entry. I have order flow in my direction, and I get to run over all these traders in this down candle. It gives this, we want to guarantee the continuation of the trade to the upside. We want to guarantee that the first or second candle we take doesn't happen here. A bunch of crazy sellers come in, give us a reversal candle, blow us out, and then the trade goes up. So we let them do it first, and then we run them over. And when we run them over, everyone caught in the counter trend candle has to buy their contracts back to get out of a losing position, and helps push the trade to the upside. The same thing here. It's great to see these sellers they're calling a top here, and they are trading in the direction of order flow. But I'll show you multiple reasons why this is not a trade, because we don't trade order flow alone. They're taking a counter trend position, and we just wait for order flow to turn in our direction, and we run them over to the upside. I mean, that's key. You need to do that. Here's another example. Right here on this pivot up, you have order flow, and up you go. Counter trend, let them do it, and then we run them over on this candle and up. We run them over on this candle and up. It's always great to have traders calling tops. Let them continue to try to call tops, because they're almost never going to be right. And in every big move, on the one on the Nasdaq today, there were tons of traders calling tops. And 3 hours later, they successfully called the top after they were stopped out about 25 times. Again, order flow is going to lead down and up. I just wanted to give you a feel. Now, the important thing is, and I have just a little bit more to go about our trading methodology and our indicators. So when we look at the trades, you're going to be able to see them, is that our main goal, our number one goal, is not to get winners, it's to avoid losers. So we don't want our software to allow us to take a trade and chop, because our mandate is to avoid losers. It's not to get winners. Every trader can get winners. I have a teenage son. If I stick him in front of this computer and he doesn't know anything about trading, I guarantee you in a single day he can get a ton of winners. But he'll also get a ton of losers. So my point is, it's never tough to get a winner. What is tough about swing trading and day trading is avoiding the losers. And if you can do that, you've got yourself a profession, and you've got yourself a very lucrative profession. We're going to go through this and just blow this out of here. Skip this all. Now, I simply want to give you the feel for a neural net. And this is I'm not going to be dogmatic about this part of our platform, but I believe that if you have a neural net, you can trade with tremendous precision. And if you don't, even a multi-time frame analysis has less throw weight. And essentially, a neural net makes a very, very simple supposition that I think everybody in the trading room would agree with. And that is, no financial instrument, no market moves in isolation. like the E-mini S&P 500 or the micro E-mini, doesn't move on its own. It moves in relation to the Nasdaq, the Russell, the Dow, gold, all the precious metals, the currencies. These are all interlinked. And if you come to the conclusion that this market moves in isolation without giving any respect to what's happening with all the other markets that correlate in direction with it, you're really selling yourself short on the trade. Because these things are, at the end of the day, if you do a significant amount of analysis, they're not that hard to track. So what we look at, if we want to trade the E-mini, we want to do a multi-time frame assessment of trend on the Nasdaq, the Dow, and the Russell. It's a 2 time frame analysis of trend. And if we take an E-mini long trade, we only want to take it long when the Nasdaq and the Dow and the Russell are also moving long. So if you're moving long on all the index equities, that can only happen when institutional money is driving the instrument higher. And it increases your chances for a win by many fold. And the way we do it, this is our simplest assessment, are these dots. You're going to see it gets more complex. But all these dots are doing is tracking the trend. This is the E-mini. Is tracking the trend of the 3 other index equities, Russell, Nasdaq, and Dow. So if you decide to take a trade here, and you've got a green dot, which tells you that the multi-time frame assessment in trend of those 3 markets is also long, the likelihood of your trading long here is very high. And it also prevents you from taking a counter trend move. These dots are green. Even though you're getting a 2 candle pullback on the E-mini, the Nasdaq, Russell, and Dow are still moving up. So you remember how we run over those counter trend traders? Well, we're more than happy to let them try to call a top here, trading divergence or whatever the heck they're doing. Because when we get this up pivot with this green dot, we're going long. And essentially, what are we doing? We're trading in the direction of institutional money. And what is institutional money saying? Risk is on. They're buying stocks. And all the index equities are going up, and they're going up on a multi-time frame basis. It's the same thing here. Now, we've turned it into a much more complex assessment, and this is really the end of the talk about the platform. These are the 3 core things that we look at. On these up candles, we've got red dots. We would never take a long trade when our 3 index equity markets are moving down. These traders are doomed. And they're not listen, occasionally they're going to be right. But I'm telling you, I don't know, 90% of the time, they're not calling any bottom. We're going to wait, and we're going to take the pivot down in the direction of money flow, because all the institutional money is driving all the index equities down. Risk is on, and risk is off, and everybody is selling stocks. And again, without dots, it also helps define a trend. Now, if there's no trend on the Nasdaq, Dow, and Russell, what's the likelihood that you're going to get a trend on the E-mini? Sort of semi-zilch. So again, our major role here is to avoid taking losers. And when there's no multi-time frame alignment in price on our 3 correlative markets, we don't trade. And it really helps us avoid taking a loser. And I'm going to skip some of these because really all we're doing is, again, highlighting how you don't take a short candle on a green dot. We're going to trade in the direction of our correlative markets. And these dots are going to censor a lot of bad trades. I mean, what's going to happen is you're going to get an alignment of the other independent predictors of price movement on your trading chart, but the dots won't work for you. So you have to stand aside, and the likelihood is you're going to stand aside on a loser. Now, in order to make it even more valuable, we did a slow trend and a fast. So now you're going to get dual dots. And on an entry, you want a dual dot. You want an X and a dot. And I'm not going to really go into this anymore. I'll show them to you on the trading chart. Now, let's keep going here. Now, we made that neural net even more complex. And what we do now I modified it since we have 3 lines here reflecting money flow. And again, on the E-mini, we're looking at the Dow, Nasdaq, and Russell multi-time frame. The dots do one type of correlation. These lines do another type of correlation. But all we're doing with these are the same as the dots. We're tracking the direction of correlative markets and trading in the direction of institutional money when all the index equities are falling or all of them are rising. It's the only time we're going to trade. Now, once in a while, one of those markets will show divergent relative strength. Like, Google alone has what happens is if Google reports bad earnings and really gets smacked around in general, the whole Nasdaq will fall because the Nasdaq's a market cap weighted index. Just Google alone crashing is going to make the Nasdaq, in terms of its relative strength, be very weak. The E-mini and the Russell, the small cap index, it may not be so weak. In those cases, you're not going to get that many great trades. And remember that correlative markets only correlate in direction 70 to 100% of the time. Sometimes they don't. Those are the trades you stand aside on. If they go on to become winners, who cares? Fear of missing out, or FOMO, is another thing that blows up I can't believe the number of traders that get blown up on that. Because you overtrade and they're scared stiff that the market's going to make a big move and they'll be left sitting there and they haven't clicked their mouse. We don't feel that way. And in the trading room, I don't think that way. If I don't get what I want on my indicator analysis, and I do have great respect for price action and market structure, as you're going to see, if the move goes on to make 155 million ticks, I don't care. I want to make the market come to me and give me what I want, or I'm not going to go in. Because more often than not, you're going to walk into a loser rather than grab a trade if you reach, and you're going to start pulling in losers. And you don't want that. Same thing. This is just a little more sophisticated analysis. We've modified it a little bit down to one line. We've just combined them. The Nasdaq has 2 lines. All the Forex markets have 1 line. And you'll see in the micros that the Nasdaq has two lines. And again, they help us define chop, which is critical. So I'm not going to even put it together on slides. I'm going to put it together on our charts. And let's move over to them. Now you're going to get a better idea of how to view the charts. Now, there's one indicator that I didn't mention to you. It's the last one, and it's the most important one. And there's 2 that I really want to, I'm not going to go into great depth with them, but you want to trade only when the instrument that you're trading is in a multi-time frame trend. So this pink is the sweetest spot to trade short, because in this case, the mini NQ or the micro NQ is trading to the downside on your 2 higher time frames. So in which direction is the NQ likely to go on your trading chart? Heck, it's going to go down. Now there are three different powers of down, which I'm not going to go into. This pink is the strongest down trend possible. And I take most of my trades with pink background. This dark green is the most powerful multi-time frame alignment to the upside. I'm going to take most of my long trades when this is green. And remember, this is not looking at price on our trading chart. I don't care what price is doing. I only care what the higher time frames are doing, because that's the direction that price is going to go. And the other indicator, I'm going to mention briefly, and then we're done. And I'm going to just show you the trades on the micros. And there were great trades today, man. Is the pivot indicator. Now, most people just, pivots is an old-fashioned indicator. And, it's kind of like, talk about the opposite of sexy. I mean, it's kind of like, if you go bald, you wear a toupee. I mean, it's just not particularly sexy anymore. But if you have a correct pivot indicator, it gives you explosive trades, and it also prevents you from taking multiple losers. Now, most pivot indicators work lazy. They take their trades and create their pivots off the wick high. And I am telling you, that's an absolute mistake. Japanese candlestick dogma creates pivots off of candle body highs. And you can see right here what happens. Price comes up, it hits, it comes back. It hits, it comes back. And then finally, it breaks the pivot. And we call this trading around the pivot. Now, a pivot's only broken when 2/3 of the candle body closes above it, right here. And I took that trade. Now, let me tell you what happens when you break a pivot. When you break a pivot, this pivot's always going to have residual sellers. I don't care how many times it's been hit. And it's just like running over traders in the counter trend direction. They snap like this. And this was my last trade for the day. Right here, I had both my quants. These are my correlative markets. Remember I told you that we're going to have two lines that tell us the direction of the Dow, Nasdaq, and Russell? There are my dark dots, also looking at the direction of the correlative markets. I had the Laguerre on my trading chart heading up. And I'm telling you, in real time, the long-term Laguerre was green. Unfortunately, fractal indicators are recalibrated a bit by the NinjaTrader platform, and they're pushed to the right. So when you open it up after the market closes, it's going to be slightly different. There's nothing I can do about it. It's not repainting. It's being reassessed. This was a perfect entry, and I got a great winner off of it. It was my closer. And I'm going to show you the speed that this went up. Here's the entry, and that's actually I missed the entry, but this went up 11.5 points on the Nasdaq. And if you look at the candle, this was 37.51, 37.52, 37.53, 37.39. Now it's slowing down, but these first four candles just snapped through the pivot because all the sellers in this pivot were stopped out. It was a terrific trade. On green background, dual dots. Now the last thing is, if you're looking for the order flow line, the order flow line has now been transferred to the candle halo. So when the candle halo is blue, order flow is long. When the candle halo is magenta, order flow is down. All you care about is what it is like on your entry. If your entry is blue, order flows in your direction, you're good to go. And order flow is kind of the quirkiest assessment, and it's the most difficult to get a grasp of. because if the moving average is kind of flat, it can jockey it around, and order flow is the most labile of all the assessments we make. And if you look at the trades from the open here, now this was very tough. Remember I told you it's sometimes hard to get in the trade. You really couldn't get into this trade until right here. Here's your pullback. All we're looking for is a wick. The wick tells us that the bears have tried to push the market down and failed. And we call this a bear failure. And look, we've got dual quants, dual gears, lock long, green background, dual dots, order flow, 50's up, 15's up, and you have a trade long. The continuation here and the trade long. Now, I wouldn't take this trade because by my accounting, I would consider this trade to be overbought. Again, it's only a subjective assessment because, you know, I'm still saying even with institutional money at play, how far the institution's going to drive this thing before you're going to get a retracement. And I'm concerned about that. Now, I want to show you one other thing. Today was a really hard day to trade the Nasdaq because it was hard to get in. When you get a market that only moves in one direction, it can be very, very difficult to get into it. And I just want to show you one other setup that's really great. And I'll show you all the markets. Let me find out where it was. Every time I look for something, I can't find it. I didn't have time to draw on the chart prior to coming. Okay, here's the analysis. It's right here. Now we're going to create very shortly an indicator that assesses consolidation. Now price here is consolidating right below this pivot. And here's really the consolidation low. Now the NQ on volatility drops. And you can see that you've got down candles, up candles, down candles, up candles. Now consolidation traps both buyers and sellers. And everyone's sweating it out in here because the sellers are calling the top. The buyers are making the assumption that price is going to resume right back into the trend. And most of the time, consolidation breaks out in the same direction it went in. Goes up and into consolidation. It's more likely to go back out into consolidation. Now, we didn't get a trade until right here, but it's a trade out of consolidation, and it's a real good one. And we're going to create a consolidation indicator. And I'll just go back a couple of more days. I mean, look at the, and let's go to the beginning of the session. And look at that trade right here. Dual quants. This is the Russell Nasdaq. I'm sorry, the Russell Dow and E-mini on dual time frames. There's your long-term Laguerre. And here's your trading chart Laguerre heading in the direction of the long term. There's the break of the pivot. I took this trade in real time. That's the reason it's already been marked out. And it's a trade I took. You snap the pivot. Order flow is with you, dual dots, another part of our neural net, and up you go. Now, you have to make a decision as to whether or not you want to take the trade out at resistance. Now, if you've locked in a lot of profit and you move your stop to break even or plus break, plus, you can take the risk. If you want to be conservative, you close the trade here. Obviously, you would have missed out on a big move, but if you're conservative, you're going to close at resistance. If you're a little more liberal and you want to give it a shot, it's going to blow through. Now, here's what happens when there's no background. Price is just going to chop. And you're never going to get a winner. I'm telling you. The kiss of death is to trade when there's no multi-time frame alignment and trend. And here's where you look for trades. Long, you don't always get one, but here's where you look. Right here. You don't have one, but you look for one here. And again, right here, clear. Let's go to the E-mini, because I know everyone has an interest in that. Here's the YM, micro, and here is the E-mini. The E-mini today was incredible on a setup. It was the pivot breaker. Now, trust me when I tell you that the long-term Laguerre was all the way over here. Believe me, it was. It was just pushed back by the reassessment of the fractal analysis on Ninja. And I don't want to get into this over, I don't want to get into a fight with Ninja. They already threw me out of the ecosystem because of my argument with them over why these fractal indicators change when you open and close. Except this was a perfect entry. I don't want to beat that dead horse, except there's the pivot break. And there's your entry, all the way up. Could you take this continuation? Green background, one quant, tells you that the Russell, the Nasdaq, and the Dow are also going long on a multi-time frame basis. Here's velocity or acceleration in rise of price across across the higher 2 time frames, telling you that price is accelerating up. Here's price on the trading chart. Momentum stays above the 80 line. Dual dots, again, part of our neural net, and up you go. I mean, that's a lot of loot on the E-mini. And then you lose the green. You start trading into a pivot, which you can't trade into, and you have no trade. There's just no, you see these up candles? Look at the dots above them. Was there any way you would take these trades long? Absolutely not. This protects you in green background. If perchance you got a long setup, these red dots, you're going to stand down. Now let me show you, I'll show you the Dow. And they all trade the same. The Dow just was in a multi-time frame uptrend the whole day. And now this is an entry that we formatted. I don't like software generated entries, but this is a multi-time frame assessment of range. You click on it and it opens. It's looking at a range chart. The analysis is buried, but it's looking at a multi-time frame range. And when they align, your pivot breaker's right here. And this is an incredibly nice trade on the Dow. Here's your continuation on the Dow. Here's your pivot breaker on the Dow. Now look at this trade right here. Would you go, if you went long here, you've got your quant, you've got your dual Laguerres, you've got your green background, you've got your dual dots, and look at order flow. It's down. This loser is censored, and you have no trade. Now you can't get this winner, but I'm telling you, you're never going to make as much money on a winner as you lose on a loser. It's very hard to get 1-to-1. So you just sidestep this whole move, and one loser has been kicked to the curb. And I'll show you the Russell, and then I'm going to show you something that you're really I think you'll like. Let me find it here. Here it is. Now I don't have the data feed connected, but the market's dead. So there's no major reason to have it. I didn't look at the Russell really today. I look at these great trades on the Russell. I mean, look at this entry right here. Look at this entry right here. This is hard. It's into a pivot. Got to take the pivot breaker and up. Background bias almost always green. Blue is okay, not quite as strong. Up you go. This one's tough because your trading chart Laguerre sagged. You want to wait for that trading chart Laguerre to be moving or sloping in the direction of your long term. So you just wait for a pullback in this move here. Nice setups, and there's no way you could have taken a short here. You don't have the quant. And look at the dots above the short candles. No chance of taking a short trade. Now, all of these are going to give you amazing setups. And this is a tool for the first 5 traders who want to come aboard that's going to allow you to trade all 4 of these at the same time. It's a really sophisticated market analyzer. And when you get green across the board on the NQ or the YM or the Russell or the E-mini, just pull that chart up. It doesn't give you an entry. What it's telling you is that every independent variable that we look for, background bias, order flow, the dots, everything is moving in your direction. All you need to do is look for an entry. So you can catch great moves on all 4 markets. Then we normally charge $1,000 for this because it really does work, because it's based on the same system we use. Right now, everything is just flat. I don't have the data. I can hook up the data feed, but it's really irrelevant because the market is closed. And you can see we have multiple inputs, and they have meaning, which will teach you if you come aboard. I just don't want to spend a lot of time. I'm already going an hour and a half. Exactly what they mean. But when you get your sell signals on the Nasdaq or the Dow or the Russell or the E-mini, open that chart, and the likelihood is you're going to see a pretty decent short setup. You may see a stellar one. So you get a lot more opportunities at trading. Also, when you see a lot of yellow, you know that there's no reason to bother to watch the chart. I mean, just don't waste your time, because the correlative markets aren't aligned, the dots aren't aligned, background bias isn't aligned. It's not working. So don't waste your time. And what you can do is you can just, if you want to trade it, take the chart, put it underneath. Let me get this right. And just put it here. And then if you see that market go green, just pop it, and it opens up. And when it's got nothing, you just close it. So the problem is these markets tend to correlate, and you're going to have to be fast, because sometimes you're going to get multiple signals on multiple markets at the same time. But that's a blessing. To have great entry signals on multiple markets isn't a bad thing, it's a great thing. But sometimes you're going to get a great Dow entry, and only on the Dow. Sometimes a great entry on the E-mini, only on the E-mini. Your Nasdaq won't set up. It'll go up, but you won't get in. So you just take all the charts, stack them down below, and pop them when you get a great trade, just like that. You're only giving that out to the first 5 because it's a really valuable tool, and it's really going to help you trade if you want to trade all the micros. And my recommendation is to try to trade all 4 of them, because you will get unique entries on the Dow and the E-mini, a lot. So let me go back and let me show you the offer, and then I'll answer any questions that you have. Now, this is operational on NT7 and NT8. I recommend strongly that you use NT8. NT8 is a little more powerful platform. It drives the analyzer better, and you have to go through. We do the whole setup for you. You don't have to worry about any tech. We do 100%. Sergio will format this for you 100%. And also remember, you do not have to trade Unorenco. You can trade time, you can trade tick, you can trade anything you like. When Sergio formats it, you just have to tell him what you want to trade, and he will format the chart for you. You want to trade a 3-minute, we format it for you in a 3-minute. If you want to trade a 377 tick, we'll help you with that too. I just showed you this in Unorenco because I personally believe it's the best way to trade the market in an institutionally driven environment that we have now. The problem, I think, with time is that when institutions come in, if you trade a 3-minute, what you get is this big, long 3-minute candle where the institutions just drove price up in that 3-minute time. You can also use it to swing trade. We have traders who trade 2-hour bars, 1-hour bar, 4-hour bars. Remember, I want to make it really clear. These are forces that drive price. They are market independent and they are time frame independent. Does not matter what you trade. Now, this is specially formatted for the micros only. And that's what you're going to get. You're going to get the micro templates, all 4 of them pre-formatted, and Sergio's going to set up your entire workspace for you. If you're one of the first 5, he's also going to format your market analyzer for you. And we always give you great tech support. So let me just quickly go to the offer, if I can find it. That's not it. Let me find it. Hold on one sec. It's right here. Oh, I wanted to show you this. Hang on one second. I hope you understand how I feel about the way the market goes. Now, here's our profit so far this month. We made $3,120. This is right off my dome. I mean, you can't fudge this number. I mean, we don't use Adobe Photoshop here to change these numbers. We've taken 49 trades, 42 winners, 7 losers. 85% of our trades are winners. You can trade with an 85% win percentage, you're going to make a ton of money. Now, 90% of these trades were only 2 contracts. If you traded, a lot, you'll see a lot of, I made $20,000 in one day. Well, sure, if you buy 1,000 shares of Netflix and you have $300,000 in your account, you can make it. But if you're trading the micro, you're going to make a smaller amount of money because this is the full contract. But don't let that 3120 fool you either. That's only with 2 contracts. And if we traded 4, 6, 8, or 10, that could easily be $10,000, $15,000. What's key is the percentage. And that's what this software allows you to do. It allows you to sidestep losers. So here's the offer. We call it our optimized multi-time frame trading system. You get the micro E-mini, the micro Dow, the micro Nasdaq, and the micro Russell. It's normally $29.99. We're going to give it to you for $13.99. It comes with the complete, everything you saw. obviously all the indicators, and the first 5 orders are going to get that market analyzer. And if you want to get entries on every one of the micros, it's a great tool because it's only going to fire for you when you've got a potentially great setup. And seriously, I would advise you, if you want to call in and get it, it's a great bonus because we do charge $1,000 for it. And I'm going to answer all your questions in a minute. The offer ends on Sunday. I'm at info@rightlinetrading.com, and our number is 786-732-4656. I'm going to leave that up while I answer any questions you might have. 1 second. I see a bunch. Let me just go to the top here. Okay, hang on 1 sec. I'll answer all your questions. Yes, you can get a recording. John, I always John W always challenges me, and I appreciate it, and I like John a lot. He writes, who has ever proven that momentum is understood in physics has anything to do with price movement in an auction market? And the fact of the matter is, nobody's compared momentum in a closed system to momentum on a chart, but momentum is a metric. To me, it's just the same, John. It's simply the change in rate of speed. That's what momentum is. Remember the formula: momentum equals price times acceleration, or momentum equals velocity. I can't remember the Newtonian equation for it, but it really does have obviously tremendous applicability in physics, and it's directly applicable to the market because price can accelerate up to its apogee. And remember that the more buying pressure there is in an auction market, the faster it's going to accelerate to its apogee or down to its perigee. So I believe that momentum has tremendous applicability to price movement in the markets, just like it has applicability to a railroad train moving down a railroad track, or to the movement of a photon, or the movement of electron in its orbit. It's the rate of change of speed, and it doesn't make any difference what you're looking at. If you're looking at a closed system, I think it's a very, very important metric to try to predict what's going to happen out into the future. Okay, Michael. Well, I think you see. The thing is, Michael, if I just went into the minis, you wouldn't understand what I was talking about. And that I really wanted to get through the indicator analysis as quickly as I could and show you how the E-minis trade. But listen, if you wanted me to just put up 4 charts on 4 of the micros, you just could have called up and I could have put them up for you. But what I want to do is I want to show you how to trade them, and I want to show you how to make money on them, because their price movement is exactly like the regular contract. I mean, price on the E-mini is the same. Doesn't matter whether it's worth $1.25 a tick or $12.50 a tick. Price is the same in both charts. If you're trading a 3-minute on both charts, they're going to be identical. So what you're really looking at, I mean, I gave you all the information about how much margin you need, how much the value is of a tick, but I also wanted to show you how you can trade them and make money on them, Michael. Hey, listen, honestly, in this day and era where people are basically trying to force software down your throat, I'm trying to really make this an educational experience, not just sit here and throw this up. That's all. No, Russ, I do not believe 3-minute candles are better. I'm just saying if you want to trade a 3-minute, you can. I mean, I don't want to be dogmatic about the Unorenco. I personally believe there's nothing better than it. But if other traders believe that and think they want to trade a 3-minute, I want them to know that the software is configurable and they can trade a 3-minute and it will work equally as well on the 3-minute. That's all. Hey, Michael. Yes, you do, Michael. You watch me and you follow me and you take my trades. Everybody in the room is doing, I don't want to mention live money, but everybody in the room is exceedingly successful. And what's really nice about the trading room is that there's a lot of traders in there that are better traders than me. I mean, we had people make a couple of grand today. They trade more contracts and they're better traders. And I think being in a trading room is really important. I didn't put that in, but you do come into the live trading room for a month. I forgot to add that. Day trading is, it's kind of lonely. You tend to overtrade because you just get bored. And when you're we have 175 people in the room. And when you're in with all those people, it tends to be more chatty. And I'm constantly thinking out loud, telling you where I think the market's going based on our analysis. And I give you we trade with Chart Trader Up. All our prices are projected well in advance of the trade. You see target 1 going out, target 2 going out, target 3 going out. We have incredible transparency. At the end of every session, I bring my Ninja Dome over and show you the back end. Show you how much we've made or lost on every single trade. We don't have trades that vanish, losers that somehow vaporize, winners that appear out of nowhere. Every trade you see. Yeah, you'll get a recording. Yeah, Gregorio, I don't want to mention their name out loud, but you are correct. And I'm telling you, that stuff that they sell is absolute garbage. You got it, James. Just like Forex, the big banks buy from their own desk to drive that market in the direction they want. I forgot to show you that big trade on crude, but it sat there forever and all of a sudden it just rocketed out. On the NQ Unorenco chart that we use, sure, Russ, we don't have any more order flow line. We project the order flow line on the candles, Russ. So just look at the candle halo. When the candle halo is blue, order flow is aligned to the upside. When the candle halo is magenta, it's aligned to the downside. The thickness and color of the halo is totally your decision. If you want that halo to be green, you can make it green. If you want it to be thick, you can make it thick. But in order to make the assessment below easier and allow you to focus on candle bodies only and looking for consolidation and break of a pivot, I don't want you to take your eyes that much off the actual trading chart. So we remove the line and just put it on the candle halo. It's much, much easier to trade. So don't look for an order flow line anymore. If you want the order flow line to appear, we'll do it for you. But then it just makes it more complex. Just look at the candle halo. This will be archived, Carol. Okay, Kim, I'll have Rory give you a call. You can go through PayPal, Stephen. Hang on one sec. Stephen, Rory's going to give you our PayPal. It does not, Kim, but if you call us and we'll talk to you about it. Is there any continuing fees that we need to pay to the company after the purchase? Sarah, there are none. You have no obligation to pay anything. You come into the trading room for a month for free. If you want to stay in the trading room, there's an ongoing fee for that. Because I killed myself in that trading room. Let me tell you. Do you know that last week I had 23 straight winners in that trading room. As God is my witness, I did not take a JPEG of it. I did not have one loser. So there is an ongoing fee, but that's totally up to you. If you want to stay in the room, you have that. But the free upgrades, the free add-ons, that is yours for life. And you never have to pay us another dime for the platform, nor for any upgrades or add-ons for the market analyzer. If we make it better, and I'm telling you we do, we will make it better because we're always making things better. You get that for nothing. So essentially, there really is no obligation to you to pay anything. It sure will, David. The market analyzer will work with the regular E-minis too. If you want Sergio to format it for them, you just let him know. That market analyzer will work on anything, quite frankly. So it's an offer for the micros, but honest to God, I'll be honest with you, you can use it on any instruments. And even if you're in Dr. Keith's room in the morning, he uses it on Forex. Everything is applicable to every market. So Gregorio, let me see if I understand your question. So if I do on micro, it is more, I don't understand your question, Gregor. Yeah, I think you have to, I'm sorry. Could you ask it again? I apologize. Did you put the PayPal in, Rory? Stephen, Rory is sending it to you now. If you don't see it, just let me know. Oh, I got you. My recommendation is to use NinjaTrader. Because NinjaTrader, we don't get any money from them, believe me. They don't even like us. But we do have a guy we work with, a broker, and we send them a lot of clients, and they will give you a very, very good round trip amount. They will knock it down for you a few cents less than they give their regular clients if you tell me from Right Line Trading. So I do recommend that the guy's name is Wayne Hedrick. We can give you his phone number, and he's a very, very good guy. And we give him a lot of clients, and so you're going to get a discount with him. That's my recommendation. And they give you kinetic data feed. I'm sorry, a CQG continuum data feed as part of the whole deal. Yeah, David, it will work with all the regular instruments. And like I said, it'll work with every instrument. You just have to have Sergio format it because each individual instrument requires specific formatting. So if you want to trade Forex, we have to format it for Forex. If you want to trade stocks, we can format it for stocks. Remember, momentum, order flow, correlative markets are operational on any market and on any time frame. And the trade analyzer, the market analyzer, will work on anything. If you want to look, I tried to make this specific for the micros, but if you want to look at 25 stocks, it'll work on that too. Khalid, if you on Ninja 7, what you're going to have to do is call the broker, and you're going to have to get them to add those instruments. And then they're going to have to send you instructions. Ninja 7 is a little more complex. You got to, I don't want to go too long, but what you have to do is you have to erase your NinjaTrader 7, download a brand new version of NinjaTrader 7, hook up your new CQG data feed, and then all your new micros will be in there. That's why NinjaTrader 8 is so easy. You just stick them in. NinjaTrader 7, when I asked the broker, how do I get it on 7? I got a whole page of instructions. Now, if you want it on 7, Sergio will help you because you're a nice guy and you're in the room every day. But it's not easy to do. You have to remove Ninja 7 and then replace it. Yeah, just it does, Kim. It does. And if you call us, we'll talk to you about it. So nobody asked me, Grigor. I'm just not sure. I mean, you should call us at 786 if you're, or you should Skype us at Right Line Trading because you'll speak to Rory and he'll answer any questions you have. I mean, Skype is Right Line Trading. It doesn't matter whether it's caps or small. I don't know if you're in the United States or you're overseas. Or call us at this number, and then it'll be a little bit easier to answer your questions directly, I think. Okay, great, Russ. Okay, Stephen. Great, Gary. Great. No, you will be in it, Grigor. You'll be in the whole program, so don't worry about that. And you can open the account with $400. We'll give you all the information on who to open the account with. We'll provide you with everything you need to open up your account. And you can open the account with $400. That I know for sure is accurate. That's all they require. My pleasure, Khalid. Does the broker provide a data feed or I need to buy one separately? I don't think you need to buy one separately, Sarah, if you have a live account. If you actually have money with Ninja, and I'm not sure which, but you know, it may vary from broker to broker. I know with Ninja, you do not have to pay. They'll just add those instruments on for you because they want you to trade them so you can make them more money in commissions. So I'm not sure what your broker is, but you do not have to pay for the additional, for those additional instruments. I mean, the payment is nothing because they're part of the CME data feed. That's all. You have the CME, you got the micro contracts. It's not a different, you know, it's not the NYMEX, it's not the COMEX, it's just the CME. Okay, Grigor, just call us, 786-732-4656, and you'll speak to Rory, and Rory will answer any questions you've got. Because your questions are, I think, are really easy. I mean, the broker will send you all the information, and you know, that information is really easy. We do the whole setup for you. You don't have to worry about that. No, Steve, this is just a one-time event. It's the first time in 15 years I've ever seen you have to remove NinjaTrader and then replace it when anything comes out. If we provide you with a new indicator, you don't have to do anything. I mean, Sergio will insert it into the NT7 you have or the NT8 you have. You do not have to download a new version at all. And we can do so many upgrades that it would be crazy. This is unique, and I was shocked when I got the information that you actually have to delete and re-download NT7 for the micros. That is something I've never heard before. So it's nothing that we'll ever ask you to do. But this is a NinjaTrader issue with their platform for 7 only. 8, you're good to go. And we're active on 8. So, I mean, if you want to trade 8, we have everything on 8. It's a good time to move to 8. The phone is right here, Gregorio. Look at the screen. 786-732-4656. It's right here. You can just call us right here. Okay? Rory, are you off the phone? Gregorio, try it now because there's nobody on the phone. And just make sure you're dialing the right number. It's 1-786-732-4656. And if nobody answers that one, I'll give you another number. There it goes. You got us. Right now, Jay, the volume is middling. I'm going to be perfectly honest with you. I'm not overwhelmed by the volume, but I think the micros are going to become extremely popular. And there's a lot of good reasons why to trade the micros over trading the regular instruments. Your round trips are still going to wind up to be cheaper. I mean, you only pay 70 cents a round trip. That's really cheap compared to $4.50. I'm sorry, it's 37 cents one way. It's about 70 cents a round trip. You pay $9 a round trip for most instruments on the, for the index equities. So if you trade a lot more contracts, it's still cheaper. And it gives you much more configurability. Like, you could take out 3 at target 1, 4 at target 2, 5 at target 3. You don't have that configurability. So I think that volume is going to pick up really nicely. And with the way it allows you to scale out or scale into the trade, I really like it. And here's the other additional thing, Jay. It's very hard to add on a contract. A lot of traders in my room do it. In the middle of a move, they'll add a contract. They're in the trade, they get a pullback, and they'll add an additional contract. To me, it provides you with substantial additional risk that I don't want to take on. But if I'm trading a micro contract, I'll add on a micro because it's so little additional risk. And if I'm already up significantly on the trade and I get a pullback and I think that trade's going to go, I'll add on one. So it really has a lot more configurability, and I really like it. And I think as time goes by, give it a month or two, I think it's going to accrue nice volume. It trades about 250,000 contracts on the E-mini right now, and it's brand new, and that is not bad. And if it gets to 750,000, it's good to go. So right now it's a little light, but I think it's got a great future. I think there's going to be big traders and big money. And let me just say one other thing, and I don't want to blab on. Right now, the institutional money is in the big contract. It's much easier to trade an instrument when institutional money isn't crushing it. They're great instruments to trade, and they trend really well. Stephen, we provide you with our Unorenco bars. That's part of what you get. And we customize them for you, depending upon what you want to trade. We have optimal Unorenco settings for any potential instrument that you might trade. And if you come aboard, I'll spend a little bit of time with you and I'll teach you Unorenco metrics. I've taught a bunch of Unorenco metric classes that I've actually charged for because not many people understand how Unorenco candles work. And they're really very clever. But we'll configure them for you, show you how they work, and give you all the optimal inputs. And we provide you with the Unorencos and we set them in your Ninja. So, your whole platform will be functioning. And if you need a little time with me, I'll be happy to spend it with you and show you exactly how it works. They're really very simple to trade. And in this market, again, I think they're the best. They're the best candle to trade. Oh, they do, Jay. They keep up with the larger index. Yes. Yes, there's less program trading. Now, that obviously that's a double-edged sword though, Jay. But remember one thing, that price is still governed on the E-mini by big money because the price of the E-mini, whether it's on the mini or on the micro or the mini, is still governed by institutional money. So to a sense, you're still subject to the whim of program trading. I mean, if they created a brand new instrument, you know, like all of a sudden, everyone in the room always kids me about trading pork bellies. I don't know, 20 years ago, you could trade pork bellies. I think now it's lean hogs. But if there was a new instrument that flew below the radar, that would be something that, you know, maybe you could get by without institutional money. But boy, they run corn, they run wheat, they run soybeans, they run everything now. And I used to trade corn, wheat, and soybeans back in 2004, 2005. Those were great markets. 12.50 a tick. The open is 10:30 a.m. Eastern. They had great volume and they were easy to trade. Now forget it. I mean, it's just a different market environment. And if you don't trade with institutional money, you're going to really get beaten up. I really mean that. Whether you come aboard or not, please adopt that theology that you can't trade unless you have big money with you. Because if you don't have big money in the market, likely it's just going to chop. I think you're right, Donovan. If you want, I can have Rory send you instructions. You know, you have to uninstall the NinjaTrader 7 you got, install the latest version of NinjaTrader 7, and I think you got it exactly right. And reset the instrument under options, data, micro, and then they'll be visible. Yes. It's 50 cents a tick, Khalid, on the Nasdaq. Remember, it's $5 a tick. It's 1/10. So you make 50 cents a tick. There's nothing wrong with that. You have much reduced profit, but you have much reduced risk. And for only 70 cents a round trip versus $9 a round trip, you can trade a lot more contracts. You just have to wait right now, potentially for a little more volume. But there's nothing wrong with trading it now. It's going to move exactly like the regular index. And that's the other thing that I wanted to mention about the market analyzer. If you get a signal on the micro E-mini, it's also good on the regular E-mini because the price setup is identical. If you get a trade on the micro YM, a flash, you're going to have that same setup on the YM. So essentially, if you just use it for the micros, you're really looking at 8 markets, and you get to pick whether you want to trade the micro contract or trade the regular contract, because the background bias, the quants, the dots are identical, because price is identical, correlative markets are identical. So in a sense, you get a lot of configurability there. And listen, if you want to stick in the 6E or any other futures contract, just let us know and we'll configure it. I'm looking at the 6E or crude oil or gold. You can put them all in the market analyzer. And every now and then you may pop a great gold trade. So listen, thank you so much for giving me your time. I really appreciate it. My goal is to make you money. It really is. I mean, I don't sell stuff I have not spent an enormous amount of time on and trade myself. I'm in the room every morning, and if you come aboard, I mean, Khalid and these guys see me every morning, and we, you know, we do the dance every morning, and it is not easy. Don't let these gurus tell you, yeah, 3 simple chart patterns, and I was living under a bridge, and then somebody came to me, and I trade the J pattern and rising triangles and falling triangles, and now I'm a multi-trillionaire and I have a Learjet. It isn't like that. But if you have discipline and patience, you can really make a nice living. You just have to wait. Today, we waited about 1 hour and 45 minutes between trades, and we got 2 nice winners. Thank you, Donovan. Donovan says he's currently trading the micro NQ, and it works great. great. And you know, that makes sense, Donovan. It really does. It really does. That's really good thinking. So listen, everyone, have a really, really wonderful evening. You will get a replay, but I think we already have 2 or 3 orders. If you want that market analyzer, and I really mean it, it's a very valuable tool. Think about it. No matter what you do, I wish you the best. I'm here. I'll help. Whether you're a member or not, I'll help you. If you have a question about trading, even if it involves your own software, I'll be more than happy to work with you. So have a great, great evening, and I wish you all the best. Take care and have a wonderful, wonderful night. Bye-bye.